You're sitting at a kitchen table with a mortgage pre-approval letter on the table. That letter says 6.8%. The rate on it. Your coworker locked in 2 years ago at 3.12. Same bank, same credit score range, same neighborhood. Your credit rating is not the difference. That's not the difference. The bank isn't being less generous this year. The difference is that you've never checked this market once, never studied it once, and never been told it matters more to your daily life than the stock market, the debt market. And if you don't understand bonds, you don't understand money. First grade, bonds you think are boring. That's where most people start. Grandpa bought bonds. They are the safe, sleepy, irrelevant corner of a portfolio that only matters when you are near retirement and you don't want to take risks anymore. They're not exciting. They're the thing financial advisors say just before you stop listening. Here is the problem with that assumption. The bond market is not a sleepy backwater. It is the world's largest financial market. The U.S. bond market alone has about $49.6 trillion in outstanding fixed income securities, based on SIFMA's 2025 numbers. U.S. Just the Treasury market, the government debt alone, is about $30.9 trillion of that, according to SIFMA's May 2026 figures. That puts the U.S. The Treasury market is the largest securities market in the world. But here's the interesting thing. Where is the bond market? $130 trillion globally. Bank for International Settlements data, December 2024. The world stock market is about $109 trillion, according to World Federation of Exchanges 2024 data. All the companies on all the exchanges on the planet. The bond market is about $21 trillion bigger than the whole world stock market. And it's not just bigger. It is more busy. The U.S. bond market trades roughly $1 trillion per day, according to SIFMA 2024 data. The U.S. stock market is about $500 billion. Bonds trade at twice the daily volume of stocks. Every day. But a 2024 survey by the FINRA Investor Education Foundation found that only 29% of Americans knew the basic relationship between bond prices and interest rates. That's the #1 most fundamental concept in the largest financial market in the world. And 7 out of 10 Americans get it wrong. It's not an accident. No one ever sat you down and explained how the bond market works. Not your high school, not your college, not your bank, not your financial advisor. And that's why. You're not wrong to be confused. And that pays off. The institutions that operate in the bond market have a financial incentive to keep this information in the world of professionals. Because every layer of complexity between you and a treasury bond is a layer where someone takes a fee. Your mortgage rate is set by the bond market. It affects the rate on your car loan. It sets your credit card rate. It predicts recessions ahead of time. The Federal Reserve carries out all of the United States monetary policy via the bond market. And no one has ever shown you how any of it actually works. Up to now. 2D level. You understand the inner workings of bonds. A bond is a loan. That's all it is. The U.S. government or a corporation needs money. They issue a bond. You get the bond. You're paying them cash. In return, they promise 2 things. To pay you interest along the way, and to give your money back on a specific date. Here are the 3 important terms. The face value or par value is the amount that the issuer borrows from you. That is $1,000 on most of the bonds. When it matures, you get your $1,000 back. The coupon rate is the annual rate of interest they pay you on that face value. If a bond has a 5% coupon and a face value of $1,000, that means the bond will pay you $50 a year, usually in 2 $25 payments made semi-annually. The maturity date is when the issuer pays you back your $1,000. It could be 3 months away, or it could be 30 years away. Those 3 pieces are easy. But here's the concept that 29% of Americans understand, and it's the one that changes everything. Higher interest rates equals lower bond prices. When interest rates decline, bond prices usually go up. They go their separate ways. Always. Let me tell you what. Suppose you buy a bond that pays $50 a year, a 5% coupon on $1,000. You are contented with that. Then the Federal Reserve hikes up interest rates. New bonds pay $60 a year. So now you have a bond that pays $50 in a market where new bonds pay $60. Nobody wants your $50 bond at face value anymore. The price of your bond must fall until the effective yield is equal to the yield on new bonds. This is the inverse relationship. It's not just that. Imagine rates drop and new bonds only pay $40 a year. Suddenly your $50 bond is the better deal. Your payout is higher, so buyers will pay more than face value. Your bond price goes up. This is the bit that should clear this up a bit. The longer the term to maturity of the bond, the more violent the price swing. The duration of the bond is known as, by Investopedia's 2025 duration analysis and standard bond math, a bond with a 10-year maturity and 5% coupon has a duration of about 7.8 years. So if interest rates go up 1%, the market price of the bond goes down about 7.8%. So a 1 percentage point move is a $780 market value loss on a $10,000 position. 2-year bond barely budges. The 30-year bond is all over the place. The reason the same change in interest rates can be felt as a ripple in one part of the bond market and as a tidal wave in another is duration. And this mechanism, the inverse relationship between bond prices and interest rates, governs more of your financial life than any stock pick you have ever made or will ever make. Third level, you see bonds that control everything. All interest rates in your life originate from the bond market. Every one of them. Let's begin with the one that matters most to most Americans, the mortgage rate. According to Freddie Mac research from 2025, the 30-year fixed mortgage rate tracks the 10-year Treasury yield by a spread of roughly 1.5 to 2.5 percentage points. That difference is called the spread on mortgage-backed securities. The U.S. 10-year Treasury yield is 4.49% as of June 2026. Treasury data. Add in the spread and you are at mortgage rates of about 6.5 to 7%. That number, the 10-year Treasury yield, is the most important number in the American housing market, and it's something most Americans have never heard of. This is the number that alters the whole calculation. From January 2022 to October 2023, the 10-year Treasury yield rose from roughly 1.5% to more than 4.7%. That's up 3.2 percentage points in less than 2 years. Data from Freddie Mac and the Federal Reserve from 2024 shows that moves sent 30-year mortgage rates from around 3% to more than 7.5%, the fastest jump since the 1980s. I will be as specific as I can. A mortgage of $400,000 at 3% costs $1,686 a month. That mortgage at 7% is $2,661 a month. That's $975 a month more. That difference adds up to $351,000 over the 30-year life of the loan. Same house, same borrower, same bank. The bond market was the only thing that was different. To complain about high mortgage rates is to complain about the bond market. You just don't know it yet. And here's the part they don't put in the brochure. The thing that moves these rates is the Federal Reserve. The Fed does its monetary policy mostly through the bond market. The Federal Reserve has the federal funds rate at 3.50 to 3.75% as of June 2026. The Fed's move from near zero to 5.25% between March 2022 and July 2023, 425 basis points in 9 months, was the most aggressive rate hiking cycle since Paul Volcker's Federal Reserve in the early 1980s. But the Fed doesn't just set one rate and walk away. It buys and sells bonds directly. This is called open market operations. QE, or quantitative easing, is what the financial media calls the Federal Reserve buying Treasury bonds and mortgage-backed securities to lower yields. The Fed's balance sheet grew from about $900 billion before the 2008 financial crisis to a high of $8.9 trillion in April 2022, according to Federal Reserve data. QT, quantitative tightening, is the reverse. The Fed lets bonds mature without reinvesting, shrinking its balance sheet to around $6.7 to $7 trillion in 2025. And every dollar of that is bond market activity. Your auto loan rate. Your loan rate. The rate on your credit card. The business lending interest rate that determines whether firms expand or cut jobs. It all comes out of the bond market. Headlines are for the stock market. Prices are set by the bond market. Level 4. You learn how to read the yield curve. The yield curve is a graph that shows Treasury yields at every maturity, from 1-month Treasury bills to 30-year Treasury bonds. In normal conditions, it slopes upward. Short-term bonds pay less because you are locking up your money for a shorter period of time. Longer-term bonds pay higher yields to make up for the risk of being locked in for decades. This makes intuitive sense. A bigger reward for a bigger commitment. But sometimes the curve inverts. Shorter-term yields are rising faster than longer-term yields. This is referred to as an inversion, and when it does, it means something very specific. The bond market, which represents trillions of dollars of institutional capital from central banks, pension funds, and insurance companies, is collectively signaling that it sees economic weakness ahead. It's pricing in the expectation that the Fed will have to cut rates in the future because the economy is heading for trouble. Here is the part that should make you freeze. The 2-year versus 10-year Treasury spread has inverted prior to every U.S. recession since 1955. Research from the Federal Reserve Bank of New York and Duke University shows that the yield curve inversion has had only one major false alarm in all that time, a brief inversion in 1966 that preceded a slowdown but not a full recession. That is about a 9-for-9 track record in over 60 years. Nothing else in the economy compares. The most recent inversion began in July 2022, lasting for about 26 months. The longest inversion on record, according to the data from the Federal Reserve Bank of St. Louis. The 2-year yield was 108 basis points above the 10-year yield at its lowest point in July 2023. That is the bond market screaming, not whispering, screaming that something was wrong. The curve has normalized as of June 2026. The 2-year is 4.09%. The 10-year is at 4.49%, a spread of plus 40 basis points. The curve again has a positive slope, but this is the detail that most people overlook. Historically, recessions tend to start after the curve uninverts, after it goes back to normal, not when it is inverted. The warning is the inversion. Often the trigger is the uninversion. The bond market doesn't just predict recessions. It does with a lead time, which allows informed investors months to prepare. The stock market was caught off guard. The bond market has discounted it. This is what they mean when they say the bond market is the smart money market. This isn't a compliment. It is a description of who is running there. There are retail investors, day traders, meme stocks, and the stock market. The bond market has the Federal Reserve, sovereign wealth funds, and the largest pension systems in the world. If those participants are moving trillions of dollars in one direction, the signal is worth listening to. Level 5. You know who profits from your confusion. Now here is where the system reveals itself. Middlemen exist in every financial market, but the intermediaries in the bond market are uniquely invisible. Begin with bond mutual funds. According to NerdWallet's 2025 fee comparison data, the average bond mutual fund charges an expense ratio of between about 0.50% and 0.60% per year. That sounds tiny. It's not little. On a $200,000 bond allocation, a reasonable sum for someone in their 40s or 50s, that fee costs $1,000 to $1,200 a year. Yearly for decades. Here's what that fee does for you. It gives you access to bonds you can get for free on your own. Link is a free website operated by the United States Department of the Treasury. You can buy Treasury bills, notes, bonds, tips, and I-bonds directly from the government at no fees, no commissions, and no middlemen. Account setup is 10 to 15 minutes. Minimum purchase is $100 according to Link 2025 data. A fund manager will charge you $1,000 a year to hold the same bonds that you can hold yourself for free. But this is where it gets more expensive. If that $200,000 bond allocation is in a full-service advisory account, the advisor charges 1 to 1.5% per year on assets under management. That's $2,000 to $3,000 a year, on top of all the fund fees, for the privilege of holding what is essentially risk-free government debt that the buyer could hold for free by spending 15 minutes on a government website. And this is the part of the conversation no one ever says out loud. If you buy corporate or municipal bonds through a brokerage, you won't see a commission like you do when you buy stocks. Instead, they bump up the price of the bond by 1 or 2%. Such markups are built into the price, said a 2024 Securities and Exchange Commission investor bulletin. The investor never sees a line item for a separate fee. The cost is hidden by design. Let me walk you through the math behind that. According to S&P's SPIVA Scorecard 2024, 87% of actively managed intermediate-term bond funds lagged their benchmark index over 15-year periods. 87%. Every year for 15 years, the fund manager took fees from you, and in about 9 cases out of 10, you would have been better off buying a low-cost index fund or going straight to Treasury Direct. The complexity of the bond market, duration risk, credit risk, convexity, yield curve positioning, creates a perception that professional management is needed. Those terms are in all bond fund prospectuses. They sound fancy. They seem like the kind of thing that requires an expert. But purchasing a treasury bond directly from the U.S. government requires none of that knowledge. You choose a maturity. You enter an amount. You submit a non-competitive bid. The government hands you the bond. Interest payments are just on time. At maturity, you get your money back. Experience not required. The sellers of bond complexity have a financial interest in keeping it around. A smart bond buyer would go to Treasury Direct, cut out all fees, and buy the same bonds the pros buy for free. The complexity is the result. The revenue model is your confusion. Level 6. You know what happened in 2022. This is proof that knowing about bonds is not optional. It is self-defense. The Bloomberg U.S. Aggregate Bond Index returned negative 13.01% in 2022. That was the worst calendar year since the index's inception in 1976, according to a 2023 analysis by Bloomberg and Morningstar. The last worst year was minus 2.9% in 1994, and 2022's loss was 4 times worse than any previous year's worst loss on record. Let me go through what is actually going on underneath that. Long-term Treasury bonds were crushed. One of the country's most popular bond funds, the iShares 20-plus year Treasury bond ETF, dropped about 31% of its value in 1 year, according to Morningstar 2023 data. The Vanguard Long-Term Treasury ETF declined roughly 29%. These are not high-risk junk bonds. These are U.S. government bonds, the safest credit on earth, losing nearly 1/3 of their market value in 1 year. Here's the number that will make people very quiet. The traditional 60-40 portfolio, 60% stocks, 40% bonds, was off around 16% in 2022. As per JPJP says, analysis by Morgan and Morningstar, 2023, found it to be the worst year for the 60-40 portfolio since 1937. Stocks and bonds sold off together, breaking the basic diversification assumption that had existed for decades. The bonds were intended to cushion the stock losses. They added to them instead. But that's where things get interesting. No dollar was lost on individual Treasury bonds held until maturity. None. Still paid at the face value at the maturity. The coupons kept coming due on time. The United States government never missed a payment. Only bond fund holders, investors in funds that are constantly buying and selling bonds at market prices that fluctuate rather than holding to maturity, realize losses. This is the difference between someone who gets bonds and someone who doesn't. Bonds aren't safe, it's not that. It's a conditional statement. Among the safest financial instruments ever invented are short-term Treasury bonds held to maturity. Interest rate-sensitive securities, known as long-duration bond funds, can lose significant value when rates rise rapidly. The word bonds describes both things at once, and most people have never been taught the difference between them. The 2022 crash was driven by the Federal Reserve raising rates 425 basis points over 9 months, the fastest hiking cycle since the early 1980s. As always, the inverse relationship between rates and bond prices did its thing. It was no surprise to anyone who understood the mechanism. People who had been told bonds are safe without being told what that actually means were surprised. And now the recovery. The 60-40 portfolio returned around 17% in 2023, according to Morningstar. BND, the Vanguard Total Bond Market ETF, returned 5.65% in 2023 and 7.08% in 2025, according to Vanguard performance data. For all those who didn't sell, the losses were temporary. People who panicked sold their bond funds in 2022 paid a temporary event. Now they have permanent losses. Same lesson as the stock market. Same price of not knowing how the instrument truly works. Level 7. You learn to use bonds on your own. Now that you understand how it works, this is where you start using it. The first tool is Link. This is a free platform operated by the U.S. Department of the Treasury. You can purchase Treasury bills, notes, bonds, tips, and I-bonds directly from the government. No brokerage fees, no charges, no fees, no middlemen anywhere. To open an account, you'll need a Social Security number, a U.S. bank account, and an email address. According to Treasury Direct 2025 data, it takes 10 to 15 minutes. Start with I-bonds. Treasury Direct says the I-bond composite rate is 4.26% for May through October 2026. That's a 0.90% fixed rate, plus a 3.34% inflation adjustment. The fixed rate remains fixed for the life of the bond. That is 30 years. The inflation part is revised every 6 months based on the Consumer Price Index. Your buying power is protected automatically. You can buy up to $10,000 in electronic I-bonds per calendar year, plus an additional $5,000 in paper I-bonds through your tax refund. You must keep them for at least 1 year. If you redeem before 5 years, you lose the last 3 months' interest. I-interest on bonds is exempt from state and local taxes, and the federal tax can be deferred until redemption. It's government-backed, inflation-protected, zero-fee savings, and most Americans have never even heard of it. Next, consider tips. Treasury inflation-protected securities. The principal is adjusted by the Consumer Price Index. According to data from Treasury Direct June 2026, the 10-year TIPS real yield is currently around 2.17%. So your return is 2.17% above inflation, whatever inflation turns out to be. can be obtained through Treasury Direct or low-cost ETFs. Tips are a way to automatically solve the problem of inflation eating up your bond returns. If you want income you can count on, build a bond ladder. Buy bonds that mature at different times. 1 year, 2 years, 3 years, 4 years, 5 years. When each bond matures, reinvest the proceeds at the longest rung. This produces a rolling stream of income, makes you less sensitive to interest rate changes, and gives you regular access to your money. Let's say you have a $50,000 ladder, with 5 equal $10,000 rungs. That's $10,000 maturing every single year. The math is clear for your broader portfolio. For instance, Vanguard's 2024 research finds that adding 30 to 40% bonds reduces portfolio volatility by 30 to 40% at the expense of just 1 to 2 percentage points of average annual returns. The S&P 500 fell 37% during the 2008 financial crisis. The Bloomberg Aggregate Bond Index rose 5.2%, according to Bloomberg and Morningstar. Bonds didn't just cushion the blow. They stood when all else fell. And here is the part most people never learn. When stocks tank and bonds hold steady, you rebalance. Sell the steady bonds to buy stocks at fire sale prices. Vanguard's 2024 Advisor Alpha research estimates that this rebalancing discipline adds about 0.5 to 1% in annual returns over time. The bond allocation is not a dead weight. It's dry powder for the next crash. Real interest rates, another concept that changes the whole picture. The actual rate is the nominal yield less inflation. Your traditional savings account gives you 0.38%, and inflation is at 3%, BLS data, so your real return is minus 2.62%. Every year your buying power is going down. A 4 to 5% high-yield savings account doesn't even keep up with inflation. 4.5% Treasury bonds provide a meaningful positive real return, real growth in purchasing power. Level 8. Proof that patience is a virtue. Ann Scheiber was an IRS tax auditor. She retired in 1944 with savings of $5,000 and a pension of $3,000 a year. She bought dividend-paying blue-chip stocks. Trade every time the market moved, her broker told her. Every correction, every rally, every news cycle, every time she said no, every time. When she died in 1995, at age 101, her portfolio was worth $22 million. The strategy was the no. She learned one thing most investors never do, that both stock and bond markets reward patience and punishes interference. The temptation to react to every rate change, every yield curve shift, every Fed announcement is the exact behavior that destroys returns. The people who make money in the bond market are the ones who buy them, hold them, collect their interest, and ignore the noise. The bond market proves it. Over decades. Between 1981 and 2021, the 10-year Treasury yield fell from 15.8% to 0.52% during the 40-year bond bull market. Anyone who bought and held long-term bonds during that period enjoyed extraordinary capital appreciation in addition to their coupon payments. Even after the 2022 crash, the worst bond year since 1976, the Vanguard Total Bond Market ETF rebounded, returning 5.65% in 2023 and 7.08% in 2025, according to Vanguard performance data. Here's the number that drives the point home. There has never been a 20-year period in the history of the S&P 500 that has delivered a negative return. And a diversified U Treasury bonds held to maturity have not failed to return principal plus interest. Never. The U.S. government has never defaulted on its debt obligations. These are not prognostications about the future. They are 150 years of evidence that boring, patient, low-cost investing in the biggest financial market on Earth produces exactly the results the math predicts. Let me address the 3 things going through your head right now. You think bonds are for old people. They are not. Bonds determine every interest rate in your life right now. Your mortgage, your car loan, your credit card rate. To learn about them is not a retirement plan. It is a financial literacy requirement that applies to all ages. You think the stock market is more important? It isn't. The bond market is bigger. It has more volume. Its signals are better at forecasting recessions than any indicator on the stock market. The market is telling you what investors want to have happen. The bond market is telling you what the biggest pools of capital on the planet think is going to happen. You think this is not for you because you don't own bonds. Yes, it does. Your mortgage rate was set in the bond market. Your student loan interest rate was set by the bond market. The bond market had a say in whether your employer added or shed jobs last quarter. Even if you own one bond, you are a participant in the bond market. Next move, here. 4 steps, total time, an afternoon. Step 1. Go to link now. Sign up for free. This takes from 10 to 15 minutes. Buy an I bond for $10,000 a year. Current rate 4.26%. Inflation protected, no fees. This is the easiest single way to get inside and understand bonds, rather than looking from the outside. Step 2. Open your brokerage account at Schwab, Fidelity, or Vanguard. Check your portfolio allocation. If you're under 40 and you've got 0% in bonds, that's a decision you made by making no decision. You might want to allocate 10 to 20% to a total bond market fund like BND or AGG. They both have an expense ratio of 0.03%. Step 3. Check your 401k. Most target date funds contain bonds as a matter of course. But if you picked your own funds, you could have had no bond exposure without even realizing it. So during the next stock market crash, you have no cushion and no dry powder to rebalance into stocks at lower prices. The loss of that allocation has a quantifiable cost that Vanguard estimates at 0.5 to 1% per year in lost rebalancing returns. Step 4. The 10-year Treasury yield. Keep an eye on it. It is the most important number in American finance. It decides your mortgage rate. It will impact your car loan rate. It tells you where the economy is going before the stock market, before the news cycle, before the pundits. Check it once a month. It takes 10 seconds. You see it now. The bond market is not the dull part of finance. That is the basis. Every interest rate in your life, every mortgage payment, every car loan, every credit card bill is decided by the bond market. The yield curve has forecasted every recession in your life before it happened. And then the Federal Reserve has all the monetary policy in the United States through bonds. The bond market, worth $49.6 trillion, trades twice the daily volume of the stock market. And nobody ever showed you how it works until now. That was not a mistake. Your confusion was the friend of the institutions that operated in that market, the fund managers who charged you fees for bonds you could have purchased for free, the dealers who hid their markups in bond prices, the advisors who charged you thousands a year for government debt you could have owned yourself. An educated bond buyer eliminates all these. That's why the education did not happen. Now it has. The board is in view. The extraction mechanisms have names. The next move is up to you. Link. A quarter of an hour. No charges. Whether you know it or not, the bond market has been running your financial life. You see it now.